Hey everyone, and welcome back to Market on Mic. I'm Natasha, and I'm here with my co-host Daniel. Hello, Daniel.
Hello, Natasha. Thank you very much. It feels really good to be back for another exciting episode of Market on Mic. Thank you
Mhm.
once again.
Yes, and today I'm actually especially excited because we're going to be talking about quite an amount of things that a lot of traders have not been able to grasp. So today we're going to be taking a simple but powerful look at how central banks around the world, key economic data, and global events all connect to move the market. So whether you're a long-time listener or you're actually tuning in for the first time, thank you for joining in. And today we are kicking off with a clear, no stress guide to the forces moving your money, whether you're a seasoned trader or simply curious about what makes market tick. And people will call this fundamentals, right?
Yeah, mostly fundamental.
So, first, we're actually going to jet set through the world's top central bank, from the Fed to the Bank of Japan. So, I'm just giving a breakdown of how this particular episode is going to go. So, let's get our journals out. Like I said, we're going to actually get to the world top central banks, from the Fed to the Bank of Japan, to see how their interest rate decisions ripples across currencies and loans. And then we would also break down the must-watch economic reports like inflations and job data that sparks fast move. Then we would also add a dash of geopolitical, highlighting a few big news events that can send oil, gold, and stock on wild rides. And then finally, we are going to zero in on one or two star performers like gold and the major stock indices, so you actually know exactly where you need to look when the dust settles. Right, Daniel?
Yeah, that sounds quite a lot of things we're going to look at today. But like you rightly said, we're going to break it down and make it very easy so you can understand all of those big banks, events, their speeches, comments, how they get to influence the markets, and what really makes this market move, and what traders or investors really look out to actually carry out or make financial or trading or investment decisions whatsoever. Natasha rightly said, if you have been listening to us, tuning in, week out, or you're listening to us for the very first time, right? So you're actually here for a long ride. I want to say thank you very much. All right. Think of this as your easygoing market tour. So we'll cover why small rate tweak in Europe can lead to the euro, or why a strong US job data or a report can actually cause the dollar to skyrocket, and how political flashpoints might bump oil prices or cause the oil prices to drop. All right, so we're going to keep it quite light, practical, and most importantly, stress free. So from interest rates to gold prices to stock indices, this episode actually has you covered.
So, guys, are you ready to dive in?
I am actually.
Do you have your journals ready? So, if you actually do, just grab your favorite drink, settle in, and let's explore the rates, reports, and the headlines shaping today's market. I'm sure at some point in all our trading experiences, our trading journey, we're just there trading, enjoying your profit, and then you begin to see crazy candlesticks.
Crazy moves in the market.
Crazy candlesticks, and it's actually very painful when you're now on the other side of that market, because you're losing money in like a blink of an
Seconds,
eye.
yeah.
In seconds, or sometimes I've actually experienced where you're actually in the good side of the market when these events play out and you're making a lot of
in a
money
very short
within
period
a
of
short
time.
period of time. So, guys, that's what we're going to be talking about: the central banks and their rate. So let's start with the big central bank and what they are doing with interest rates. So let's talk about the US Federal Reserve. We already know that on this market, US is what? The big boy.
Yeah, they are the one in the world
Great.
class.
Irrespective of the classes of instruments you trade, you want to pay attention to what the US is doing. The US have been world power for more than a decade now, and we have to respect them in the market. So when the Fed raises their rate, and I think we started to see a lot of that back in 2022 when inflation started.
Yeah, and mostly it has been a tug of war into cut rates in the US because of inflation and things like that. But I think majorly they started to do that. That was, I think, last year or last 2 years when they finally decided to start cutting rates. That was in late 2023 or early 2023. I can't really remember.
Yeah.
But yeah, it was actually a huge turnaround for the dollar during that period.
Okay, so you might be wondering, so how does this affect the market? So when the Fed raises the rate, it becomes more expensive to borrow.
Yeah, true. Because if you're increasing interest rates, you don't want to borrow money because you're gonna have to pay higher rates
Yeah.
on your loans, and it more or less slow down the economy.
Yes, it actually does. But it also strengthens the US dollar.
Yeah, definitely. It causes the dollar to be scarce. When something is scarce, the prices kind of increase.
Demand and supply, guys.
Exactly, demand and
Yeah.
supply.
So when you see the US increase their interest rate, this will definitely boost the strength of the US dollar. And a stronger dollar often causes gold and oil prices to drop.
Yeah, it does, because gold and oil prices are valued in dollars. Yeah, so if the dollar is increasing, then definitely we'll see the gold or the oil prices begin to depreciate in price.
And this can also put pressure on US stocks.
Yeah, because now if you look at the stock market, right, interest rate and the stock market, they are two different things. Now, if you're increasing interest rates, businesses find it hard to loan money from the bank.
Sure.
And if they can't really get that cash, it will be difficult to run their businesses, right? So it literally could cause the stock prices to actually begin to depreciate in value.
Okay, so I actually do hope we're all getting this, right?
Yeah.
So when you actually see a rise in your interest rate, this means that you would definitely see a pullback in markets like gold, oil, and also the US stocks. So you want to pay attention to what the US are doing with their interest rate if you're a trader of probably the US stocks, oil, or gold, so that you can pay attention, know what direction to follow at every given time. Then we have the ECB, which is the European Central Bank. I think before we get there, I think what's the interest rate for the dollar at the moment?
The interest rate for the dollar at the moment, they've left it steady at around 4.5, between 4.5 and 4.75. So get within that particular region.
Okay, so now, guys, for the European Central Bank, we've seen higher rates from the ECB support the euro. So basically, every higher interest rate supports that particular currency, right?
It does.
So we see that the higher rates from the ECB support the euro, and the stronger euro can actually hurt European export. I think it's basically just the same thing when it comes to economy.
Exactly.
Right? So when we see a higher interest rate in a particular economy, it gives strength to the currency. However, when it comes to things like export, when it comes to things like
inflation,
stocks, right? We see it going the other way. So a stronger euro can hurt European exports, but also help reduce inflation. I think a higher interest rate is one way that the economy uses to reduce inflation.
Yeah, they use it's more like a measure, right? To cost inflation. More like it tightens the economy so that money is not really circulating around.
Okay.
So it will actually cause inflation to depreciate. So that's one of the major things that the central banks usually use to curb high interest or high inflation.
All right, so guys, to make it easy, once there's so much money in circulation, we have inflation, right? Because now there's so much money in circulation and the goods prices are crazy, they are skyrocketing, and the government needs to keep the prices of things at a particular level. And one way they do it is to increase interest rate. So when we see this increase in interest rate, it gives strength to the dollar because now there's a scarcity for that particular currency, and then we see other areas of the economy suffer, the exports, the stocks, and just like that. So now I think this works across all economies except Nigeria. I like to think so because I really did not see the effect, but I'm not here to do that. So guys, what about the US Federal Reserve and also the European Central Bank? Now, definitely, if you're in the currency market, I'm sure you trade your Euro USD, your USD JPY, most of the dollar pairs, you want to be aware of this. Even your GBP. So we have the Bank of England, which is a BOE. And once they raise rates to fight inflation, it also strengthens this particular currency. So basically, when you see countries increasing their interest rate, it tells you to look out for a strong currency in that particular area. So we see that this strengthens the British pound and also affects local businesses and consumers. Just like what Daniel said earlier, once interest rates are up, you don't want to even borrow, because at that point in time, you're going to be paying tooth and nail. At that point in time, nobody wants to borrow, nobody wants to do anything. So businesses actually suffer. And that is why you see stocks, everything just stumbling down, because higher rates can slow economical growth and weigh on the stock market. I hope we're getting this.
Yeah, quite interesting, because these are like some of the major tools that as traders or investors we should actually get to look at, because it can cause the market to move in certain direction for quite a period of time.
Period of time.
Exactly. Like for example, during the period when the US rate was up, right? It was very difficult. We were seeing a lot of weakness in the dollar, right? We're seeing a lot of weakness in the dollar, and it was really, in fact, we literally saw, we had traders and investors always looking or begging to see when the interest rate was going to, the Fed were going to cut the rate and things like that. So
Yeah.
it's actually very an important topic to look at as traders or investors.
Yeah, so you want to pay attention to it. So you can see that when it comes to trading, it is all about information. All about information. Then we also have the Bank of Japan, BOJ. I don't know why I like that name, BOJ. It just resonates with me in one way. So we see that Japan has actually Japan keeps interest rates at very low. I think they are one economy that hardly increases interest rate.
Yes. They've been in deflation for a negative interest rate for a long for years.
Yeah.
Until recently, that was sometimes last year when they started to hike their rates bit by bit, started coming out of deflation, because Japan, the BOJ or the Japanese economy, they hate inflation because they are more or less major exporters, and they usually consume a lot.
Yeah.
Exactly. So it is very, very important for them.
Yes. So I think this is where this one actually has a much more different reaction, because we see that due to they like to keep their spending and investment low, and this usually weakens the yen, which helps Japanese exporters. However, it can also lead to higher import costs.
Yeah, it does. And if you listen to our last episode, the BOJ, they were looking at keeping their rates steady. That was last week. And we made mention of the fact that if they should keep their rates steady because of the tariffs going on here and there, which was actually going to causing the BOJ to be very crazy. So and they kept the rate steady, which actually caused a level of weakness in the yen. Yeah, so we could see the level of weakness in the yen, and other major currencies just literally took advantage.
Yeah, so if you're actually wondering why this is probably different, don't forget that this is a major exporting economy. So they actually produce a lot, and as much as they produce a lot, they cannot consume everything. So that is why you'd see most of your products that you use made in China, made in Japan, somewhere around that. So they need to be able to make sure that whatever it is that they are manufacturing is being able to go out of the economy. So for them, keeping interest rates low is really important. And then we have the Central Bank of Nigeria. Daniel, can you actually take this one? Because I'm not so sure.
For Nigeria, because when it comes to, I think one of the major drivers of inflation in Nigeria is exchange rate. It's actually exchange rate. And we get to see the exchange rate, availability of foreign currencies in the economy, and all of those things. So most times it's difficult to see interest rates and inflation working hand in hand. It may not really work or seem to happen the way it actually should, because in fact you could see the Central Bank of Nigeria increasing interest rate, and inflation also is still increasing, and things like that. I don't know how Nigeria do it.
Yeah,
how they get to their money. So I don't know whether they don't keep their money in the bank. Most likely that's the reason, but it should happen the same way. We're talking about Nigerians' interest rate, because interest rate is used to curb inflation or control inflation. But it's actually one way or the other. It supports the naira. Sometimes it actually does. Sometimes you see it supporting the naira, or things like that causes exchange rates to drop, right, against other major currencies. So it majorly affects exchange rates other than even inflation.
Yeah. And if there's one thing I noticed, our inflation rate, our interest rate is about double digit.
Yeah. That's crazy.
That's crazy. That's a crazy money that we're talking about. So if you're going to borrow right now from any bank in Nigeria, I wish you all the best. Think about it really carefully and make sure it is worth it.
Yeah.
Right. Make sure that if you're using it for business, make sure your business plan is tight, because the interest you're going to be paying on it, and depending on how much you're taking.
That's actually quite exciting coming from interest rates. So let's shift it a little bit to other economic events that you should actually look out for. Right, so there are quite a couple of them. Looking at inflation itself, from the consumer side and also from the producer side, because there's also a consuming and there's a consumer and there's a producer part of inflation. Look at job reports, looking at GDP, looking at the purchasing power and things like that of consumers and things like that. So, and let's look at inflation first of all. These are like major reports that traders have to look out for every month, because they can literally cause prices to shift or cause the market some certain level of momentum, either short term or long term. So you must also be having your eyes on these data from time to time. For example, a report like the CPI. CPI is just consumer price index and PPI is producer price index. So they're like measures, they are like the data you use to measure inflation in the economy, right? So if inflation is rising too fast, the central banks literally, like we said previously, they may need to raise rates, right? So more or less curb overspending in the economy and more or less hold money or hot money into the economy, and this can lead to stronger currencies. And on the other side, it causes the bonds or the stock markets to actually be weak. Let's go again, let's look at the job data. So for example, in the United States, the first Friday of every month, we have traders or investors looking at something we call NFP. NFP is non-farm payroll. So you're looking at the jobs that were being added into the economy for like on a monthly basis, aside from farming or farm related jobs. So strong job numbers, like once we see a strong amount of jobs being added into the economy on a month or in a particular month, it actually shows that the economy is healthy.
Yeah.
And if an economy is healthy, I mean, it attracts investors into that particular economy. And this can also lead to the interest rates to be hiked also, because strong job numbers will mean, okay, a lot of people getting more paid jobs and inflation also could actually still increase. But weak job numbers can lead to talk of lower rates, right? Can cause the interest rates to actually be cut.
Yeah, just like the way Trump is pushing for the US.
And he is actually really pushing for the Fed to cut the rates.
Yeah.
Let's also go a little bit further. Let's look at the GDP. GDP is actually gross domestic product.
Okay, so guys, in case you're wondering, right, that okay, how do I know all of this?
Keep up to all of this.
How do I keep up? Trust me. One word or one sentence, forexfactory.com. We have a lot of them, a lot of sites that can help you do this. And I think once you've decided to become a committed trader, that is something you want to look at every single day before you decide what bias you'd want to go on your market, right? You want to check out, okay, am I expecting any change of this data? Because yes, they can cause a change in your trading, in market movement on that particular day. So you do not want to be caught unaware. It is always nice when maybe you're on the side of the market, maybe you have a release of this news and you just happen to be on a buy and the news is causing the market to buy. But trust me, it is nowhere funny when you're on the other side of it. So you want to make sure that these are things like naturally when you're learning to trade, they'll tell you, oh, this is called the Trader's Bible, because it is something that you have to look at every morning. Like I think somewhere we're going to be having the FOMC, which is actually going to be today.
Yeah, the FOMC is actually going to be released. That's on the 7th of this month, all right? And that should be on Wednesday. And it's actually quite crazy because the Fed are really looking, or Trump is actually really pushing that the Fed cuts the rate, and they're not seeing any economical reason to do that, because although inflations are coming down, but we are still seeing that the job data in the United States is actually quite healthy. So the Fed, you really want to be cautious in terms of cutting rates and things like that.
Yeah.
All right. So thank you very much, Natasha, for that. So let's look at one more, and we could actually also tag some important websites where you can literally track this data. Put on your notification on your phones or your tablet or whatever you're using.
Yeah, keeps you updated.
Exactly.
Yeah.
So we have the Forex Factory. We're going to tag the link so you can literally just click on them. There's investing.com, there's FX Street.
We have Financial Juice.
So we have Mutas. We have quite a couple of them. So we're going to tag a few of them for you to take advantage of.
Yeah.
All right. So let's look at one more economic data. That these data are being released on a monthly basis. So there's also the GDP. GDP is gross domestic product, and it really just measures how the economy is expanding or tightening. So a growing economy is good for stocks and it can actually lead to stronger currency. So if the economy is growing quite all right, it's quite attractive for investors, and you see a lot of investors wanting to invest into that particular economy, right? And actually could lead to stronger currencies. But if the GDP is slowing down, it causes the current currencies to be weak, and you may see investors moving their funds into safer assets like gold, because gold is a risk averse
Safe haven.
yeah, it's a safe haven for
Yeah.
investors and traders. So when you see maybe GDP slowing down in any particular economy, if you check gold, you see that gold is rising. So this can actually help you to make proper trading decisions, and whether you should be trading a particular instrument or a particular financial asset or not. You understand? So it actually really helps you navigate the market much better. All right, it's quite excited. Yeah.
All right, guys. So now we've actually spoken about, let's not forget, we've spoken about the important banks. That is, every bank in every economy is important. When you decide to pick, like I would always say, when you decide on a particular instrument you like to trade, you've actually decided on a particular economy you want to focus on. So you want to pay attention to what the central banks are. You also want to pay attention to economic data that moves that particular market. Market sometimes is more than that, right?
Yeah,
like
sure.
right now, as much as we have all of this data coming out, like our GDP, PMI, if you've been trading for, I think, the beginning of this year, you realize that those news have not really moved the market
As it used to.
as
Yeah.
it used to. I remember when CPI, PPI, the market is jumping, we're having gaps and all of that. But this year it's been very quiet because something else is moving the market.
Yeah, so and, those are like geopolitical events. Like for
Yeah.
example, you should not all put your eyes or focus on those economical events alone. You should also look at some geopolitical events, because it can literally cause the market to really shift. Like for example, during the time of the COVID-19, crazy, a lot of things happened. See Russia-Ukraine war, how it really scattered the oil market.
Yeah, and
Cost going to-
GDPs, the CPIs, the PPI, they were doing so much in the market. I think depending on what is happening in the economy, that is actually what's going to decide what gives strength to this particular news. But guys, if there's one thing we know right now that is moving this market, we know about the geopolitical events that actually causes markets to move. And sometimes the markets react to not numbers, but to news. Like I said earlier, fundamental. So that is why as a trader, you cannot say, oh, I'm a technical trader, I'm a fundamental trader. You have to be both as a trader, because we want to make money. We do not want to lose money. So to be able to reduce your risk as well, you have to be up to date with what is happening. So we've seen that the trade tensions, we did this in our, two
episodes ago.
Yeah. We talked about the trade tensions between big economies like the US and China, and how it has actually affected the global supply chain and also caused sudden move in commodities and currencies.
And it literally caused the USD to be very weak.
Yeah,
And we saw gold just rise.
gold has been making me happy. I don't know about you guys, but gold has been making me really happy. And then we've seen conflict or instability in regions like the Middle East. And I'm sure we already know about the Israel-Palestine war. And that has been one major push that has actually given push to both our oil and gold prices. These things are actually very important. We've seen elections. I know that somewhere in November, I wanted to see the US election. We saw the market do some really crazy reaction. And also political changes in major economies can bring uncertainties. We were talking about how Trump was talking about firing Powell, and we saw what that actually did on the market. It made the USD really weak. And these things can actually bring uncertainty and cause market swings, especially in local currencies and indices.
Yeah, that's very correct. Let's go a little bit further. So how does probably different fundamentals or geopolitical events or economical events, how do they affect different markets? Like rightly said, if you're looking at probably your interest rate is being hiked, it actually really causes the currency to be strong. Like for example, in the United States, if they are increasing the interest rate, it actually reflects on that particular currency. We're going to be seeing the dollar strong, but on the other side, we'll see gold drop it, to see the oil market dropping too. And if geopolitical events that are happening, like probably Russia-Ukraine war, the war in the Middle East between Israel and Iran, and maybe
the new one
the
coming
tariffs,
up.
So the tariffs it has caused gold to keep rising.
By this time, you should know that we're looking at another geopolitical tension. We're seeing between India and Pakistan. And we're still really looking to see where is it going to play out on the market. what should we be looking out for? Because trust me, we've already seen it go from talks, we've seen it go from gunshots, and now we are actually looking at, okay, this thing might be going into a full-blown war.
And if that should happen, guys, you should be looking at further upsides on gold.
Further
upsides. And we're also seeing the Middle East war escalating again. I saw a tweet from one of the Israeli prime minister saying that they are not going to stop until they are victorious, right? Fully win.
If you don't know, at least Israel mottos is never again. And you know what Israel have been through, especially in the hands of Hitler. And you will know that those people are not joking. They are not playing. So please, if you want to find trouble, don't go to Israel. Because they would wipe you out, right? So we're not here to probably make support of all of this news, good, bad, actually affects the market.
Yeah, they affect the market.
Yes.
So you should actually get to understand how each of these events affect the market and what direction or how does it affect the market, good or bad. Does it cause a particular financial asset to appreciate in price or depreciate? So you should actually have an idea. Like rightly said, if there's any fear anywhere, anyhow,
guys,
any place,
look out
for gold.
It's an opportunity.
Right? Yeah,
yes, the news might be bad, it might be scary, but it's an opportunity to actually make good money.
Exactly. And for the stock market, once there's uncertainty or fear, you see the stock market crashing.
Yes,
right. You see the stock market coming down. So you should actually have an idea, and this episode brings that to you, so you're able to make better decisions next time. So sometimes you feel that, okay, why is my technicals not working? I expect market to buy from this support or to sell from this resistance or something.
Market
you should actually
to something else.
Exactly.
Yeah,
so the market may be responding to something else. So you should actually have your eyes to look at, okay, what's presently.
You do not want to be blindsided, right? Because you already know how frustrating it is to lose money.
Yeah.
So one of your risk management, apart from it being your stop loss, is to actually be aware of these things that can change market direction. So guys, we've actually covered central banks, major economic data, big geopolitical triggers, and key assets like gold and indices, and they're all connected. They are all connected. Knowing how one affects the other helps you to stay ahead of the curve.
Yeah, that's very true. It helps you to stay ahead all the time. All right. So you are day trading, you are investing long term. Understanding what moves the market is the first step to making better financial decisions. Like I said earlier. So it's very important that you are quite aware. Put your notifications on at all times so you're quite aware. And risk management, guys, no matter what, just keep your risk management in play, right?
Tight.
Yeah, great.
Yes. So that is for today, guys, and thank you for joining us in today's episode of Market on Mic.
Yeah, so guys, don't forget to subscribe to the channel, right? So subscribe to the channel on YouTube, like the video, share with your friends, put down the comment, and also check the comments for the links that we're going to drop on this different how to track economical events from time to time.
Yes,
all right. Until next time, stay informed, stay sharp, stay smart, and see you in the market. Bye.